Um, well, thank you for everyone for joining us at this Oxford Real Estate panel on Asia Pacific property and the response to the pandemic. I'm very pleased to have three very accomplished panelists with me today. They'll be covering the breadth of Asia Pacific, starting from the top in the north, where we'll have James, who'll be focusing on the China market. We'll then be moving to Mel, who'll be looking after ASEAN for us, and then finally Steve, who'll be looking after Australia. As I said, they're all incredibly accomplished. I'll be handing over to them personally to do some introduction shortly. Before we start, a brief background on myself. My name is Richard Kuda. I'm the head of Asia Pacific for International Investment Services, a boutique consultancy operating out of London. We help businesses expand abroad with a particular focus on the Asia Pacific region. So it is my pleasure to be moderating today's panel. As I said, we have James, who's the head of research for mainland China for Savills. He'll be focusing on the mainland China market. We have Mel Siu, who's an EM credit analyst at Kering Asia. He'll be focusing on the ASEAN market. And finally, Stephen Spiros, who's a partner in the real estate and finance team for Addisons in Australia, and also property lawyer for a number of years in Australia as well. So on that note, I'll start from the top and I'll work our way to the bottom. James, I'd like to start with you if you'd like to give a brief introduction of yourself.
As you mentioned, my name is James McDonald. I head up research for Savills in mainland China. I've been out here now for coming up to about 20 years with Savills now since 2005, so 15 years within Savills, always within the research department. So I run a team of about 25 people. We have offices around about 18 cities throughout mainland China. I'm currently based in Shanghai, covering the office, retail, hotel, residential, logistics we're starting to look at, and data center markets, also looking at capital markets as well as leasing.
Fantastic. Thanks, James. And Mel, over to yourself.
Hi, I'm Mel Siu. I'm an EM credit analyst covering Asia with a fund manager called Global Evolution. I have a bit of an indirect relationship to real estate. I'm a credit analyst. I moved to Singapore 4 years ago to cover Asia. Before that, I was covering the European markets. And I first started looking at, I guess, property names in 2009, 2010. There weren't many in the capital markets. They were all mainly banked. But obviously, as the stress with the banks took over, then they all started to come and want to issue bonds. So that market grew nicely. Mostly REITs. But then when I moved to Asia, I've been looking at property developers. So main markets for me are China, but James pretty much got that covered, and also Indonesia. And I'm also now currently working on an issuer from Vietnam. So, and obviously I'm now based in Singapore, so I can talk to the Singapore experience.
Thanks, Mel. And last but certainly not least, a very good personal friend of mine, Stephen.
Hello, everyone. My name's Stephen Spiros. I'm a real estate and finance partner at Sydney-based law firm Addisons. We cover the nation and also New Zealand on I suppose a variety of different legal matters, but in terms of my particular focus, it's mainly acting for REITs, large institutionals, in relation to property development type matters across the country and into New Zealand.
Thanks, Stephen. Now, I appreciate that we're going to have a global audience on today. Some would have deep knowledge of the Asia Pacific property market, some might not. So I'll keep the same running order, but I'd like to throw it over to the panelists just to give some salient features of your market and outline some of the major differences, say, to the UK market. So James, I'll start with you for China.
Well, there's quite a lot of differences, I think, between the UK and the China market. For a lot of long-term institutional investors, one of the bigger risks is actually the land tenure. It's not often talked about just because it's been in place for a long period of time, but most commercial properties, you have land leases for about 50 years. And so once you actually come to the last 20 years, we don't know how these land leases actually be dealt with when it comes towards the end. And so many investors will look at sort of relatively new buildings where they've got sort of a longer runway on the investment. I think one of the other bigger issues is just that we're still in a very high growth market. So markets like Shanghai, we've got great office space within the city center of around about, say, 13 million square meters, but we're adding 3 to 4 million square meters over the next 3 years. So we're still in a construction phase, even though these markets are very large and relatively mature, we're still adding on a tremendous amount of new supply. Most of the stock that's being built is speculative stock, so it's being built without any pre-commitments, typically trying to do pre-leasing 12 to 18 months prior to actual completion. And so it's a very, very different market. The residential market, just briefly, what I'd like to say is that, again, it's still very, very much primary developer-driven market. So a lot of the data you actually see about China is about developer sales versus resales. And if you actually look at the yield profile and the cost of borrowing, then there's quite a significant dislocation compared to other more mature markets where often your mortgages are sort of 5 to 6%, but your actual yield on your residential investment is about 1.5 to 2%. And that also goes for the actual commercial institutional investment market as well, where you've got a negative yield spread on a number of your investments. So, I mean, I could go on and on and on, but I'm sure some of these other issues will be sort of raised as we go through some of the other questions.
Absolutely. Definitely on the commercial side, get the sense it's if you build it, they will come. So, Mel, I'd like to give us some highlights in the ASEAN market.
Yeah, sure. So I can speak probably mostly about Indonesia. So if I think about the industrial space, then that had been, there's quite a lot of developments around Jakarta, benefiting from, I guess, offshoring out of China. But, with the movement restrictions and the lack of inbound traffic, that has moved more towards a bit more of a domestic market. Although, there are projects that are going on. So, I mean, just today in my market, my space, Hyundai is trying to raise some capital to finance their manufacturing plant that they have just outside Jakarta. So that's going to make 150,000 vehicles. So, but that is a project that's been going on for a couple of years. On the resi side, that has been, I guess, plateauing for a few years. Everyone hoped that after the elections a year or so ago, when Jokowi got re-elected, that would sort of reinvigorate the market. But that is still, I guess, kind of a bit in a sort of long-term slump and hasn't really recovered. They've tried to stimulate it. Foreigners can't buy residential property, so it's very much a local market and an owner-occupier market. Really, the investment side of that hasn't really recovered. And in retail, there have been a couple of transactions. It's been kind of a bit special situation. So there was this sort of related party sale from an asset owner to its REIT, and then there was another distressed sale recently. But that's probably the asset class along with residential that is looking to be a bit more robust rather than sort of office space or the industrial space.
Yeah, and Mel, we were discussing yesterday about Vietnam and particularly when you're talking about the tourism assets and holiday lets, and you said that in some markets like that, the domestic market has really picked up where kind of the foreigners left off.
Yeah. So I mean, Vietnam is, I think it was unique last year in terms of posting GDP growth that was even higher than China's. I think 2.9%. last year, and I mean, from my colleagues on who cover sovereigns, they really like Vietnam. They think it's 6.57% GDP growth, and they managed to control the coronavirus, which allowed them to maintain domestic travel. And if you know Vietnam, it's a very long country, so domestic tourism is down 10% last year, whereas in a country neighboring Thailand, it was down 43%. In the Halong Bay area, domestic tourism was virtually flat. So, and then with sort of growing incomes, people are keen to buy property. So, it's probably perhaps where China was a few years ago in terms of that rush of people to try and put cash into real estate. So this one developer I'm looking at is developing 2 tourism townships, and doing very well. It's very well placed.
Okay, thanks for that, Mel. And Steve, although on the surface of it, people think that in terms of rules, regulations, the way Australia works, it's very similar to the UK, but I appreciate when it comes to property, being somebody who's had the privilege of buying properties in both, it's very, very different, and some may argue a lot more direct and straightforward. But Steve, if you can, tell us a little bit about the salient features of the property market in Australia.
Sure. I think your comment is a very fair comment. We're obviously based on a common law legal system, so very similar to the UK, and we've borrowed a lot from the UK and continue to do so. But in relation to real estate, we are slightly more streamlined in terms of approach than what happens in the UK. And the main reasons for that is we have something that we call the Torrens title system, with central registers for title that guarantee indefeasibility of title. So what that does mean is that our deals can move quicker and somewhat less risky as well, rather than sort of going through chains and chains of title, discovering unregistered easements and things like that. It doesn't really happen in Australia. It's a very efficient way to do real estate deals, and a lot of foreign investors really enjoy, I suppose, the certainty of it, because it's all underwritten by government in relation to indefeasibility, and there are very few exceptions to that rule. So quite similar to the UK. Apart from that, there's quite a remarkable difference, I would probably put it. In terms of what's going on in Australia, we have unprecedented growth in real estate prices, so growth that we haven't really seen for 30 odd years. We're calling it a new real estate market every week. So the usual sort of comments we hear is, well, I overpaid this week, but the market fixed it for me the week later. So that is generally the picture across most real estate asset classes. There have been some that have been affected in a negative respect, mainly around student housing. The main reason for that is obviously quite strong borders that we've set up in Australia to keep the virus out, and as a result of that, we've lost a lot of the international students coming in, and that particular asset class has suffered. Big box commercial is doing extremely well. A lot of investors very quickly move money into that as a real estate asset class, particularly given our very low interest rate environment. Again, probably the lowest in the history of the country. We've seen a lot of movement in the bricks and mortar space, and residential real estate prices are growing too quickly, and there's a concern about how quick we are moving. And the same is the position in New Zealand, and there's been a lot of government intervention that's been spoken about in New Zealand to try to take some heat out of the market without moving interest rates.
Thanks, Stephen. I think most of the listeners in the UK on this call would bite your arm off if you told them they could have a chain-free sale or purchase. So a lot more streamlined. I know we briefly highlighted it in our kind of high-level briefs on our markets, but I'd like now particularly to focus on the pandemic. I assure the panelists we're doing quite well for time, so feel free to kind of speak as long as you need to. But I wanted particular to cover all the asset classes and how they've performed over the pandemic. And also wanted to cover both the policy responses from the respective governments, any rules and regulations changes. So for example, Mel, you were talking about, broader spacing, limited people in offices, and also any of the kind of practical real life kind of effects that it's had on the markets to owning property or the way properties are set up. So for example, less occupancy because people are more spread out, or having to put expensive systems in place like thermal scanners. So in keeping with the order that we've been going through, James, I'll open it up to yourself first.
Yeah, so I mean, even though China was the first one affected by the pandemic, it's actually been one of the first ones to come out of the other side. So I mean, just in the case of Savills in our office here in Shanghai, despite the fact that the virus was first much more broadly known towards the end of January, and it started to spread beyond Wuhan, we were actually able to get back into the office about a month later. So we started on a rota system, and then we were back into full occupancy by, I think it's the end of March, beginning April. And we've been sort of operating pretty much at full capacity. We haven't sort of changed too much in terms of the way we actually use the office space over the last year. And I think a lot of our clients and a lot of the other tenants within office buildings are similar. There are obviously changes in terms of the way that property management deals with potential risks, and we have had, while sort of generally speaking, the virus has been under control, we have had a couple of local outbreaks, which has spooked a couple of people and sort of generated a response from the local government. But generally speaking, we've sort of been back to normal for quite a long, prolonged period of time. So some of the changes in terms of what property management doing is that, or sort of the municipal government's actually sort of enforcing, is that everybody has to wear masks on public transportation. We have QR codes that sort of basically indicate whether we've been to a high risk location or not. So if there has been an outbreak in a certain part of China, it will say that you traveled to that part of China in the last 2 weeks, and therefore you're a low risk or high risk category, and you won't be allowed into certain public locations. There have been sort of travel restrictions between different provinces and cities, which has tried to sort of, again, limit the scope in terms of potential spread if there has been a local outbreak. But I mean, generally speaking, like I said, things are back to normal at the moment. There are very few vestiges of what we actually saw last year in terms of the commercial markets at the moment. There has been acceleration of trends that we've seen prior to COVID-19. So obviously sort of degree of flexibility in terms of working from home to a certain extent. But I mean, the management style that we see in China is very, very different. The home situation can be quite different. You can often living in very small apartments. Often the commute is relatively short because you've got great public transportation, and often offices are actually much more pleasant surroundings to be in than at home. Given that you might be living in a multi-generational dwelling, you may have kids or dogs and sort of other distractions. So it's actually, a lot of people have actually preferred to come back into the office. So it's not been a particular hardship. And so, like I said, on the office side of things have rebounded relatively quickly. We don't have any social distancing. All the workstations are full at the moment. Retail, we obviously e-commerce penetration in China has been one of the highest globally and the largest e-commerce market in terms of total dollar value for a long period of time. We have seen some innovations in terms of e-commerce, and again, the percentage of retail sales that can be concluded online has continued to grow. So we've seen things like group buying. So that's when residential communities will buy a vast amount of goods in one go and then redistribute that within the residential community. So that's a new form in terms of e-commerce. We've seen social e-commerce, which was again rising prior to COVID-19, but with a lot of online media. How do you capture that? How do you monetize that? And how do you sell goods on the back of that? So we've seen platforms like ByteDance, or the Western equivalent of that is TikTok. So it's the same company but different brand. So they're trying to monetize that and move into e-commerce and mobile online payments. So they're creating whole ecosystems through that social media platform. And so we're seeing that happen as well. So there's tremendous amounts of innovation in terms of that. We've also seen a significant acceleration in terms of fresh foods delivery. So again, platforms like Freshippo or Hema, they already had quite a strong platform, but that's only accelerated, and we've seen other competitors come into that space. So retail, again, continues to shift online, but then retail, more landlords have continued to shift in terms of offering so much more experiences. Instagrammable locations, offline brands going to offline stores, online brands going to offline stores. And then if we look at the residential market, residential was incredibly swift to actually recover. So again, there was a limitation in terms of going to sales offices or transacting in terms of residential properties in February and March last year. But then by May, we're at pre-COVID levels, and by June, I think we're up 10-15% on pre-COVID levels in terms of transactions. Pricing in first and second tier cities started to grow by mid-year. And a lot of the individual city governments have actually started to enforce restrictions to try and cool price growth at the moment. As part of the stimulus package, we've actually seen acceleration in terms of investment and development in terms of the industrial and logistics market, and also the data center market as well. So we've seen a fiscal stimulus to look at new economy sectors, so whether it be R&D, life sciences, data centers, modern logistics, cold chain storage. There's also been the announcement that we might actually see the REIT sector finally being established in China this year, with the idea that a lot of that will be infrastructure including business parks, logistics and data centers as well. So there's lots of expectations around that at the moment. And then investment, again, took a hit, not much certainty about what was going on. And so not necessarily wanting to conclude on a deal at pre-COVID level pricing, but then owners not necessarily wanting to discount too heavily. And so there's a bit of a disconnect in terms of price expectations, which sort of stalled the investment markets, apart from deals that have been previously started negotiations in 2019. We're starting to see that open up a little bit more, just because not necessarily the prices have come down significantly, but just I think that expectations and optimism going forwards has picked up. And so I think a number of investors are starting to say, look, we've got a ton of dry powder. We need to start to execute some deals. I think that's pretty much everything. I mean, there's a couple of other things I could touch upon, but I'll cede the floor to some of the other panelists.
Well, we might return, and then I'm sure they'll be brought up in some of the other responses. But yeah, definitely whistle stop tour. The changes to the retail were particularly interesting because I think one of the few sectors in property that seems to be suffering a bit in different markets is the high street. But it seems China's already kind of responding to that with the experiences and also the kind of convincing of, the online to move to offline. Because we've seen a little bit of that in the US with Amazon and their kind of, till-less shops, but seems like China's ahead of the game there.
Yeah, and so just to mention on that, I mean, so we have actually seen new brands coming to the market. I mean, Five Guys is actually just opening up across the road from us. They just opened up yesterday, so it was their first location in China. And Popeyes opened up last year as well. So there's new international F&B brands that are coming through. There's a ton of new startups in terms of Chinese brands as well. And I think the Chinese brands are able to turn around much quicker, and they're able to then understand sort of the local dynamics. And it is incredible how quickly the local brands are actually starting to pick up and take on market share as well.
Oh, wow. Very interesting. Okay. Look for Krispy Kremes and Shake Shack next.
Shake Shack is here. Krispy Kreme's actually was out here a couple of years ago, but they actually closed down the operation. So not everything works. Not the high calorific, very, very sweet donuts, apparently.
Yeah. Perhaps they should have made a mooncake flavored one.
Indeed.
Mel, throwing over to you and kind of what we've seen in the ASEAN markets.
Sure. So I can talk about what we're doing in Singapore here. So and then I can talk also about what the Indonesian companies have experienced. So I mean, in Singapore, it's kind of a little bit like what James was saying in terms of China, but we're not totally there yet. So we have QR codes to enter buildings and offices. You have to scan in and theoretically scan out, but everyone does check you when you're scanning in. There's temperature scanners, so every building did have a person outside initially with a handheld scanner, and they now upgraded that to an automatic thermal scanner now so that you get rid of the lines coming in. They've recently increased the capacity in offices to 75% of personnel. It had been 25% and 50%, and it's been going up. The various ministries, I think companies have to submit very detailed plans in terms of how many people they want to have on the floor and adherence to all these different standards. So it's pretty onerous. And it'd been quite a while, I guess, while people were still working from home, because companies had allowed people to choose, right? I guess similar to what's happened in other countries because of that fear, right? So, and some people actually got used to working from home. I haven't been in the office for a whole year, or haven't seen their work colleagues face to face for a year, right? Especially if you're team A and team B, where you're alternating weeks. And people have just adjusted, I think, and that. So I don't know what will be the long-term impact, whether you have to force people back in the office to see their co-workers or not. Retail is kind of back as well. I mean, it had suffered with the restrictions in opening hours, but the shopping malls here in Singapore are totally packed. You really can't tell pre-COVID to post-COVID anymore now. I guess some of the higher end brands are suffering because Singapore being very reliant on inbound Chinese tourism, like a lot of countries in the world. So that has suffered. But everything else it seems to be doing very well. The nightlife and the food and beverage sector is kind of suffering. It's a little bit like going back to the UK 10, 15 years ago. Everything shuts at 10:30, 11 o'clock now. There's really no nightlife. So all the taxi drivers are that's their peak time for work, and then it kind of shuts down now, apart from the occasional party you might be having. In terms of the property markets, I don't know if people are just saving a lot and don't have anywhere to spend their money now, but the residential property market is doing very well here in Singapore. I think plus 3% last quarter in Q1, so about 1% a month. They're thinking about, or there's talk about additional cooling measures. The government likes to keep property prices pretty stable, so once they get up too high, there are cooling measures. And I know buildings, old residential buildings, 30, 40 years old, they do what's called an en bloc sale occasionally and tear it down and build smaller units, more of them, sell them for the same price. And that's the sort of business model. And so that's something that's a bit under pressure. In Indonesia, they had, I guess, a bit more of a serious outbreak with COVID. So they've had more onerous restrictions to opening hours. Kind of like in China, the ability to market residential developments was curtailed. There was also I guess in response to that, a restriction in terms of new launches. The government has stepped in a way that in Singapore, I didn't talk about any government assistance because there really wasn't any. There was the odd sort of rental relief to tenants, but nothing specific. Whereas in Indonesia, you're seeing quite a few measures come in. So VAT was reduced on properties below 2 billion rupiah, which is about 130 odd thousand US dollars, from 10% to 0%, and between 2 billion and 5 billion rupiah, it was reduced from 10% to 5%. And this is on completed properties to help the developers, I guess, clear their completed inventory. So you've seen Q1 marketing sales 30 to 40% higher than Q1 last year, and the expectation for that to continue. On the retail side, on the malls, the expectation is that you're only going to really recover in 2022 and start to see that in the back end of 2021. So landlords have been having to give rental relief to tenants, and they've done it on a case-by-case basis because, certain classes of retailer have been able to be open. So, your critical services like your pharmacies or things like that, your food and beverage are pretty much restricted, 50% occupancy. And so it has varied. The stronger landlords with better balance sheets were very quick to support tenants. Maybe some of the weaker ones have not. So there has been a bit of a disparity in terms of occupancy. Some of the stronger ones, one of the stronger ones I follow has kept occupancy in the sort of mid 90% level. The average is down in the mid 70s, and middle of the tier is like mid 80s. And they haven't really started the releasing for this year because they've just been, as they say, firefighting. That's what else can I say? And then I mean the big thing in these markets as well, last point I'll make is the policy around mortgage disbursements. So if you think about mortgages that are released to developers, it normally follows a percentage of completion. But I guess to help the cash flows, as much as 95% of the mortgage can be dispersed upon signing of the SPA. So that has really helped the cash flows of developers, with sort of that 5% being left to, I guess, formal handover, whenever that is. So that has been a big help. We've seen this in Indonesia and also in Vietnam. That has led to them, this one developer I'm looking at, shifting from 5% of its contracted sales in 2019 being mortgages to 60 odd percent. So that's a big change in how they've looked at their contracted sales and tried to convince their customers to take on mortgage products to help their cash flows.
And was that something that was instituted by the government, or was that self-regulation by the finances?
No, that was government mandate. Yeah, to say that, I guess the financial regulator said, so long as you change the conditions in terms of the disbursement, because they're trying to, I guess, get the banks to keep the flow of credit going. So I mean, you've also seen interest rates come down in Indonesia as well. So I know that mortgages, a couple of years ago used to be sort of in the 9-10% range. They're now about 6%. So, I mean, that's a huge difference. Right?
Big difference. Stephen, I'll throw over to you to give us your perspectives on the Australian market.
Well, the Australian market had a very interesting response to the pandemic. So towards the end of February last year, and certainly March last year, there was a huge amount of fear across the country, and how would we be affected? And what we saw is Australia moving to some extent to a protectionism type of policy in relation to foreign investment inwards into Australia. So we have rules and regulations just like most countries do in relation to foreign investment coming in. Australia became very concerned from a political perspective on controlling, I suppose, its food security, its water security, its PPE, medical supplies. It became almost obsessed with ensuring that agricultural land in particular remained in the hands of the Australian people and Australian investors. So we had our notification threshold through our Foreign Investment Review Board reduced across all real estate asset classes to $0 Australian. So any form of investment coming inward to acquire interest in Australian real estate, whether it was an off-the-plan new residential apartment being bought for, call it $500,000 Australian dollars, or to buy dairy farms and so forth for much higher amounts than that, all became subject to government scrutiny. And the response periods had moved from 40 days from the time the applications were made. They were pushed out to 6 months just because everything became heavily scrutinised. At the same time that this was all happening, again, probably similar to most economies, uncommitted deals fell away almost overnight. So, we'd gone from fairly stable real estate market to a very unstable one. That probably lasted for about 6 to 8 weeks, was the feeling. And at that particular point in time, new government policies were coming in to assist tenants across residential, agricultural, retail and commercial spaces, where landlords and tenants were forced to come together and do deals to ensure, I suppose, the businesses on both sides survived. The banks also instituted policies to assist borrowers, again, corporate and residential, and were granting sort of interest-free periods and so forth. That was all government mandated. And a lot of these policies have since come to an end. So in particular, the Foreign Investment Review Board changed the notification thresholds back to original levels effective 1 January this year. We've definitely seen a lot more foreign investment come in, particularly over the last month or two, and the activity we're seeing is very much coming back. We're seeing very stable. Our growth rates in our GDP are very strong. We had one quarter last year where we contracted by roughly 7% as a nation. That was very quickly made up across the next 2 to 3 quarters. It's almost as if we've forgotten about that one negative quarter. And it was a quarter when we're all stuck in our homes and basically just pretended like nothing else was happening, and we're ducking for cover. But we've since recovered. I mentioned to you that for about 4 to 6 weeks there was turmoil in terms of the uncommitted deals. What we saw, and this is just by virtue of the nature of developers in particular that we largely act for, they tend to be quite bullish. So they saw it as an opportunity. While there were a lot of exits out of the real estate market, that they thought that it was a good time to start putting money in. And the size of the transactions very much increased very quickly. And I think this is what's caused the run-on in the real estate market, because just within our own practice, our site acquisition values probably went up by about 400 to 600% since about June last year. So we're in my own practice, we're doing several billions of dollars a month in acquisitions, and that hasn't changed since about June last year. So that's also had a flow-on effect with residential. There seems to be a lot of movement again, because people can borrow at roughly 2 to 2.5% interest rates, which are historical lows for Australia. And given people aren't travelling and the like, and people got a taste of what it felt like to spend more time at home, we're seeing a lot of in particular, the luxury home market moving very quickly. So where you might have bought a house in a Sydney suburb of Vaucluse for about $8 million 12 months ago, you can probably expect to pay 14 for the same home now. It is very patchy, but even in the patches, there's still been very excessive or high levels of growth in the property market. So I mentioned there are only a few asset classes that have been affected in a negative way. You mentioned high street shops, Richard. There seems to be a bit of a push recently in the last quarter or two towards high street shops. And I think that's because people very much learned that going to a Westfield shopping centre wasn't the way to go during a pandemic. And it's brought local demand back to high street stores, which is actually quite nice to see the boutiques making a comeback. So there have been some real estate investment flows back into that as an asset class. But we are very much growing in concern about how quick our property prices are moving. So we're expecting that housing affordability another generation from now just won't exist, and will be much more similar to the New York, Manhattan and Hong Kong legal markets in terms of housing affordability.
It's very interesting, Stephen, particularly the growth in property prices. I think since we've been born, everyone's been mentioning of a property bubble in Australia. But I think everyone just assumes it never exists, because every time you doubt property prices in Australia, particularly in Sydney, Melbourne, they just keep on rising and rising and rising.
Well, it's certainly not a lawyer's job to comment on the economy, right? And on future growth in real estate prices. But every year I say it has to come to an end. And for the last 10 years, I sound like a fool. So,
Stephen, you wouldn't be the first armchair economist to comment on that, and I'm sure you're not going to be the last. That's great, guys. One kind of theme that was coming through was kind of the changing of the capital flows. So I was hoping to just get a gauge from yourselves about the capital flows in the property market in your countries, whether you see them drop off, increase, grow, and the mix of that, whether there's been a changing of the guard somewhat from mainly foreign flows to domestic flows. So James, perhaps if you tell us a little bit about what you're seeing in capital flows in terms of China.
Yeah, so I think last year, obviously, one of the biggest issues is travel restrictions. So if you're a foreign investor but you don't have a physical presence in China, then actually being able to physically review the site is incredibly challenging. So I think some of the foreign investors were unable to actually continue to invest in the China market purely because of the physical barriers in place. I think there was also some concerns about how the economy is going to rebound, but I think now that has generally sort of cleared up, and so I think foreign investors are wanting to come back into the market. I think the biggest issue with the Chinese capital market is just that for so long it's been classified as emerging markets. So you're looking at most of the actual returns actually being from capital value growth, and now that we've seen obviously a disruption in terms of that trend, people are starting to question the logic behind that, and they're starting to look at it and say, okay, the yields that you're able to generate can't cover the borrowing costs, and so we need to start sort of questioning that. We need to see some more yield support for the investment deals we want to actually look at doing. We want to look more closely at who the tenants are, even though we only look at typical lease terms, maybe 3, maximum 5 years. They still want to make sure that the right industry cluster. So this is specifically for the office market. They still want to make sure that they've got the right industry cluster, that sector of the industry is going to continue to grow, because not all sectors of the economy are going to grow over the next 5 years. There will be the manufacturing sector, the trade sector, which may be impacted, but you'll see clusters where you're looking more at life sciences, R&D, and advanced manufacturing, that those areas of the property market with the strongest sort of tenant base in terms of, sort of the mid to long-term growth potential that you'll start to see investors focusing on. I think also similar to everywhere else that we're seeing globally is that the office and the retail market people are shying away from, and they're tending to pivot into the sort of the new economy sectors, or again, logistics, data centers. We're also starting to see some investors even look at the healthcare sector, the education sector. With the education sector, it may be an international school, it may be sort of a purchase and lease back, so it may be a 20-year tenant, which is obviously something that you don't typically get in the commercial markets in China. However, these sectors are incredibly small, incredibly illiquid, and so obviously the returns may be there, but the potential risk can be quite significant. And often you're working with a local joint venture, and that tends to be government or SOE backed, and so there may be risk there as well. But I mean, obviously, China's a massive market; it's one of the biggest commercial markets in the world, and investors have raised capital and they do need to deploy it. So it's looking at the one that it's not necessarily. It's just trying to find the right balance between the amount of risk that you're willing to be able to take on versus the returns you're getting. And at the moment, the returns that you're getting within the commercial market don't justify the risk that you're taking on, given the sort of cyclical nature, given the supply dynamics that we actually see in the market. And I think investors are willing to take on a little bit more risk to get higher returns within some of these more niche sectors, even though the liquidity is not there. And as I mentioned before, with the potential REIT legislation, or the fact that the REIT legislation was announced in April last year, and we're starting to see some REITs being created, potentially for launching in the second half of this year, then investors are looking at potentially being able to exit into the REIT market. We're also seeing less funds being active at the moment within the commercial markets, but we're probably seeing longer term investors given the current point in the cycle at the moment we're seeing. I don't know if there's any particular questions on that you want to sort of delve into further.
No, we're wary of time, so I'm because there's a few other things that I want to kind of get through. I'll also pop in now. We have had one question. We're going to save questions to the end, and we're going to get onto them very, very soon. But if you do have any questions for the audience, please put them in the chat box, and we'll try and address them at the end. Mel, just moving on to you, how you're seeing the capital flows in the ASEAN area?
Sure. So again, specifically in relation to Indonesia, I mean, the office market, mainly in Jakarta, has been pretty oversupplied for a while. So that is, it's been very difficult to get any meaningful transactions there. In the retail space, which is that it's interesting because mostly shopping malls. So unlike what Stephen was saying with people's hesitancy in Australia to go into shopping malls, none of that in Jakarta or Indonesia or in this part of the world. But in Jakarta specifically, the traffic's so bad that people tend to spend several hours in the shopping mall, and they don't go from one shopping mall to another. So these shopping malls tend to be pretty big. They have quite a few offerings. They might have some lifestyle offerings such as a cinema or bowling alley. They may have a very wide-ranging food and beverage offering, and then people just hang out there at their weekends. That's how they spend their weekends. So people are very constructive in that particular sector. But I haven't. The one, I guess, landmark transaction was a related party one. It's public. It closed last year. It's Lippo selling its Lippo Puri Mall to its REIT. It has a 30% ownership of a REIT, Singapore listed entity, and that was quite well received. I think it seemed to help both sides. The parent needed to shore up its balance sheet, and the REIT got a very good asset. The only other transaction I can think of was one that was bought out of distress, really. So there was a 13% cap rate there. So that was a very good deal for a strong landlord that was able to use cash on balance sheet and execute that pretty quickly in that market, because it was quite keenly contested, I understand. On the resi side, traditionally had been closed to foreigners, but Indonesia's thinking about opening it up to foreigners. That they had when Jokowi got re-elected, they came up with this omnibus law to try and relax a lot of restrictions and regulations. And then one thing that they're thinking about is trying to allow foreigners to participate more into the real estate market. So that would be a big help. And that's probably what I have been done.
Thanks, Mel. And Stephen, you touched on obviously the rules around foreign investment, but how have you seen the capital flows go across the sectors in the Australian market?
Certainly that we suffered from that perspective last year. This year seems to be different in the activity that we were seeing towards the end of last year. I suppose in anticipation of the relaxation of those foreign policies or foreign investment policies has resulted in more flow in. There is a difficult relationship at the moment between Australia and China, which traditionally has been an enormous source of investment into real estate into Australia. I'm hoping that'll change, but we are definitely seeing a lot more investment, I would say, in this last quarter than we probably did 2 years ago around this time, out of Hong Kong particularly. We seem to become much more favourable to some European nations as well. So we are seeing more activity coming out of the UK and Germany and France in particular. The US has seemed to be quite stable, although it dropped off during the pandemic. I think we're seeing pretty similar levels to what we were seeing pre-pandemic from my own perspective.
Great. This one's going to be the last kind of pre-packaged panel question, let's say, before we move to the Q&A. But it's also an opportunity to, it seems like the respective markets are starting to come out of the pandemic, if not are almost on the other side, knock on wood. So what future changes do you see happening in your markets that is going to affect property? I know, particularly starting with China, James, you were talking about the introduction of REITs. So feel free to be broader than the pandemic here. So just changes in general that you think can have a big effect in the short to medium term.
Well, even before the pandemic, what we had was a sort of campaign to look at reducing overall levels of debt within the property market and the corporate community as well. And so what we're actually seeing now is that now the economy is getting back to normal, that we're starting to see the government authorities looking at restarting that campaign to actually look at financial de-risking. So prior to COVID-19, it was very much about peer-to-peer lenders. It was about the overall levels of debt within the real estate market. Now what they're actually doing is they've got this thing called the 3 red lines, which is looking at developer debt levels and trying to pare that back. So if you cross a certain number of lines, then you're limited in terms of your ability to issue new debt or expand your overall debt levels. And so that's obviously having quite a significant impact. We've seen some smaller developers actually defaulting on their bonds, which is raising issues as well, or the ability to raise new debt. And so what we're looking at is some of the smaller developers potentially selling off assets or portfolios to other developers. We've seen a number of property management firms being spun off into Hong Kong IPOs. So we saw 20 developers actually separately listing their property management firms within the Hong Kong market. And so we are looking at some of the developers trying to recapitalize over the last sort of 6 to 12 months or so. So that's obviously a big thing at the moment. And then obviously with the REIT market, again, if some of those developers do have exposure to some of the sectors which may be covered by the REIT sector, they may be looking at putting together some of those REITs as well. But yeah, I mean, obviously governments internationally are being very, very lenient to the economy, to the property sector, to all aspects of the economy. And as you start to see the economy get back to normal, then the real hard work starts to begin to try and rebalance the economy and look at some of these structural issues that may have built up over the last year or so.
Okay, great. And then Mel, what are future changes? You mentioned, obviously trying to increase foreign investment, particularly in Indonesia, but what future changes do you see happening across the ASEAN markets?
I mean, I guess there's still, some potential to be going from further opening up of economies and the easing movement restrictions. I mean, some of it, there is a bit of a mixed experience in the region here in terms of who's coped with that. And yet, I mean, I think a big driver for the region will be, continued offshoring from China. So, this was obviously a process that was started when the trade rhetoric was amped up when Trump was in office. But I think, the planning that goes behind it and where you want your footprint to be, and people thinking about the resilience of their supply chains, I think that is a trend that will continue. So, Indonesia is a beneficiary, Vietnam as well, and then some of the other regions. So those are probably the two main themes, I think, that underpin it.
And I mean, you talked about it from a political perspective, but do you see that also being driven just by, increasing middle class in China, increasing cost of production in China? Is it partly as much as that as well?
So yeah, I mean, there is I guess a push factor in the terms of they might have thought that they were too concentrated in terms of China, so you're diversifying your bets, right? But I think also from China's point of view, they aren't so unhappy to see maybe some of this low value manufacturing go. You know, if you think of what the Made in China plan is about, they're investing in semiconductors, they're investing in tech and AI. So for some of this, you know, labor intensive manufacturing assembly to go offshore, and I don't think it's such a bad thing from their point of view. So
very much moving to a very developed economy. That's for sure, if not already reached there a number of years ago.
Sorry, just to jump in there. And so just to reiterate what Mel was saying, China is, willing to give up some of the low end manufacturing, moving to sort of high end, reshoring some of the stuff that they've been relying upon overseas markets for. And also one of the big drivers has actually been the sort of dual circulation system, which is basically trying to reweight to actually look at domestic consumption as being a key driver of the economy going forwards, the services sector, consumption sector to be a driver of the economy going forwards. And so they are looking at reweighting that.
Okay, very interesting. And to round off, Stephen, I know you and I had a brief discussion about you know, changes in particularly in New South Wales, stamp duty, the retail market, and how it's meant to make housing more affordable, but perversely will probably drive the prices up. But, you know, for Australia, how do you see future changes coming over? And, you know, if you can opine as an armchair economist rather than a lawyer, the effects it will have on the market?
Well, I think the biggest effects, I think, in the real estate market from the pandemic are still in relation to commercial office.
Mm-hmm.
You know, and there has been, I suppose, an acceleration is what we're calling it towards you know, a more mobile workforce type model. Australia is a very large country, and our skills in terms of population aren't necessarily all found within Sydney City or the Melbourne CBD. So there is a bit of a shift to move workforces to a less permanent fixture within the office. And you know, we're seeing different permutations of that. It might just be that particular commercial offices might be running, you know, a 50-50 type model, staff working from home, staff coming in, but we're also seeing a slight shift towards people working permanently from home. I wouldn't say it's a great proportion, but there definitely has been some sort of shift towards that. Even pre-pandemic, there was a lot of new NLA coming on in the Sydney office market, particularly in the A-grade office tower market. We're not really sure how long that's going to take to fill. So the way that we typically work with commercial office leasing in the Australian market is landlords will charge a face rent, which is largely to be ignored because we have these side deeds or incentive deeds that really dictate what the real rent will be. The face rents have stayed largely the same, but the incentive sort of grew from an average of say 15 to 20% to about 35 to 40 in the height of the pandemic. That might have come down slightly, 30 to 35, but we do think that that's going to take a while for that to come back. We're not sure if the same yields will be available in that sector for a while. And given interest rates are so cheap, and there is, I suppose, a lot of movement of capital within Australia at the moment, we see that a lot of the larger developers are trying to be predatory, I suppose, take advantage of compressed yields and repurpose buildings. So there is a bit of a shift that way. In terms of what else we'll see, you mentioned some stamp duty changes. So that's a duty imposed at a New South Wales government level, not an Australian government level, on purchases of real estate within the state of New South Wales. Yes, it does look like there will be a huge shift in the way that stamp duty is calculated. It's a huge cost to property transactions. It ranges between 4 to 12% of the market value of the real estate asset, depending on the kind of asset and who the buyer is and if they're a foreign purchaser. We're now looking at moving more to an annualised tax. And the effect of that is to apparently make housing more affordable for people, because we do have a housing affordability issue. But as you mentioned, Richard, at least in the short term, the likely effect will mean increased borrowing power and capacity of homeowners, and probably another push in real estate prices as a result. We're also expecting as the Australian economy opens up to more foreign visitors, which will take some time, that demand levels will start coming into the asset classes that have been affected outside of commercial office. So I mentioned student accommodation and those sorts of asset classes we think will come back quite strongly. They're probably just a year to 18 months away. So there has been a shift, but I would say we feel like we're in our new normal now. We feel quite stable. And I think that the government's role at the moment is to try to keep us as stable as possible and just to, I suppose, probably take a little bit of heat out of the market, because we are growing concern about how quickly we're moving.
Okay, thanks, Stephen. I have one question from the audience, and it's going to be kind of our only one before I close off. But it's more of a general one, and happy to throw it out to the panelists. So, how big are the downside? The question is, how big are the downside risks to these APAC markets from the current issues around shipping and global trade? So, James, if you wanted to start with that, I can repeat the question if you like.
No, that's fine. I mean, obviously, China's had some trade issues over the last couple of years with different trading partners. But China generally has tried to pivot towards more Asia Pacific versus so Europe, North America, Australia. And so I think some of those are bearing fruit, both in terms of the RCEP agreement, which was signed towards the end of last year, beginning this year, and also the Belt and Road Initiative, which means that they're just trying to look at strengthening different relationships with different countries where they have maybe more influence. And so I think we're still seeing tremendous amounts of trade happening. And obviously China to a large extent was trying to fulfill its commitments of the agreement with the US in terms of buying more US products. But obviously with COVID-19, it was hard to increase total consumption significantly over that period of time. So I think trade is it's used politically sometimes, obviously in China, but I mean, obviously China's still a growing economy and it's consuming more and more and more. And so we are looking at increasing imports quite significantly. It just depends on where we're actually going to be importing from.
Okay, great. And Mel or Steve, did you want to jump in about your respective markets?
Yeah, I mean, I think global trade seems to have rebounded quite well. I mean, we were talking, I remember last year, a bit about deglobalization and in terms of maybe trade barriers going up around the world. But if I look at the trade data, I mean, Korea posted very strong export numbers recently. I mean, China's export numbers also very good. Indonesia as well posted strong export numbers. So it doesn't feel like that is a headwind at the moment. I mean, when we were talking at the sort of peak of, I guess, pressure on China, the impact on ASEAN would have been on, I guess, the supply chain, and the fact that China would source a lot of intermediate goods from around the region, but that looks like it's fallen by the wayside. So.
Great, and Steve?
I think probably from the Australian and New Zealand perspective, it's probably just more of a concern in relation to inflationary type pressures in our respective markets. We're already seeing price rises across a few sort of consumer good areas, particularly in motor vehicles and some others. I'm not sure it'll have a huge effect on our economy, but nonetheless, that seems to be the effect at the moment. I don't think it'll affect our exports so much. We've got bigger issues with China. I think we would all like to resolve that are affecting our exports, but I think it's more a bigger issue from an import perspective for us.
Okay, thanks for that well-rounded perspective, everyone. I'm going to move to close the session now, but before I do, I imagine there's a few people on this call that would be looking at investing in your prospective markets or work for developers or potentially REITs that may kind of be active in your markets. If people are interested, are they able to contact you, and what's the best way they should do so? LinkedIn, or through your company's respective websites? Throw that out to yourselves.
Any and all.
Okay, absolutely. Mel, Steve, assume it's the
Yeah,
same.
Same, I'm on LinkedIn, yeah, so people can feel free to reach out, yeah.
Same here, Richard.
Okay, thanks.
Any way they'd like.
Perfect. Well, hopefully this generates and leads to more business for everyone across the board. On that happy note, I'd like to close off. I'd very much like to thank my three panelists, James, Mel, and Stephen. Your insights were great and very timely and provide really good grounding of what's going on in your respective markets. On behalf of myself and all the panelists, I'd like to thank Ross McCaskill for Oxford Real Estate for organising this and having us, giving us the privilege to speak, and also Syed Business School for running this as well. I'd like to wish everyone, whether you are in the world, a very happy evening, a good day, or for those of us in the UK or in the Americas, a very good morning. Thank you, everyone, for joining the panel.
Thank you.
Thank you.
Thank you.